మీరందరూ నోట్ చేసుకుని క్వశ్చన్లు అడగండి. Good morning, sir.
Morning, sir. Very good morning, sir. How are you, sir?
Fine, sir. Thanks for joining us. We're very happy to host you.
It's a pleasure to be here, sir. Thank you so much for hosting me, sir.
Our just give me 2 minutes, sir. I'm just setting up.
Sure, sir. Sure. It's all right.
Okay, sir. Yeah, okay, sir. Fine. And on behalf of all my students, sir, finance students who are studying this course called Investment Analysis Portfolio Management.
Yes, sir.
I welcome you, sir. Piyush Kumar is a I'm very silent. Piyush Kumar sir is a founder and CIO, Chief Investment Officer of Shark Square Capital. I am very much surprised by the title, that is the name of your company, sir, because sharks are always there in the market.
Yes,
so
sir.
The small fish get eaten by the big fish.
Yes, sir.
So
Absolutely.
people
Sir.
with small capital, our small investors' capital will be taken away by the sharks.
Yes, sir. It happens, sir. It happens in the market, sir.
Yeah. So I'm very happy to invite you, sir, to enlighten our students about the actual strategies being practiced in the live market, and you are in the market because we study in an academic context.
Yes,
but
sir.
how you practice that the fine art and science of investing.
Yes,
So
sir.
I would like you to explain to our enthusiastic and very active students of Narayana MBA Finance.
Sure, sir. I would love to share our framework, sir. I'm looking forward to it, sir.
Thank you.
All right, sir. So should I start sharing my screen, sir?
Yes, sir. Please, sir.
All right, sir. Just give me a moment.
Yeah,
I'm sharing the screen. Just, sir, you haven't enabled the screen sharing, sir, actually.
Yeah,
Please enable the.
Yes, I think. Can you share now, sir? Can you just try?
Let me check. Just a second, sir. Just a second.
Yeah.
All right, sir. Is my screen visible, sir?
Yes, sir. Yes, sir. Excellent.
All right, folks. Thank you so much for inviting me here. I'm really grateful and humble and honored to be here. All thanks to Dr. Dhananjay, sir, for inviting me. So today we are going to talk about how we think about stocks. A lot of people focus too much on mathematics, investment mathematics, formulas, and all the stuff. But the thing that will separate you from the market participants and from those who actually make profit is how you think about stocks. So the main important part behind investment is your philosophy. And we are going to look forward to our framework, how we think about stocks while investing our clients' money. As it's been only a year since we started our operations, we are still a young company. We are managing somewhere around 7 figures of our clients' money and even our own money. So our framework of investing in Indian capital markets. So let me give you a little background about ourselves, from where we are coming and why we are coming from there. Shark Square Capital was started by two young guys, Piyush Kumar and Mr. Arvind Kumar. Mr. Arvind he's my co-founder. He was my classmate back in school. So we launched Shark Square Capital back in November 2021 out of our own home. We had no capital. We had no so-called formal education as such, but we later educated ourselves. with the purpose to serve people in edtech, asset management, and business consulting. As of now, we are operating in three segments. The first is edtech, where we teach people about how to make money in the stock market from beginner to advanced level. Second is asset management. As we are just starting, we are managing our own money, our clients' money. We are in asset management business as well. And the third component of our business is business consulting. So we are totally a bootstrap startup, and this is just the beginning. So let me tell you something about myself as well. I completed my education from Vidya Bal One Senior Secondary School, New Delhi, and I started investing really, really early. I was 15 years old. I was 15 years old when I started up reading about stock market. And at 18, I said, boss, this is too much. I'm not going to just read about the markets. I'm going to start investing. And trust me when I say this, starting early is the main point in the market. Once you start early in the market, you will get the real life experience of the market. So the number one thing that you need to do is to start early. So currently I'm certified by BSc, NSc, and NISM, and I'm a CFA candidate as well. And read a lot of books about Mr. Warren Buffett. And when I came to know about Mr. Warren Buffett, I said, boss, I need to start something of my own. That's where our startup Shark Square Capital was born. Now let's look at Indian capital markets. Over the last 20 or 30 years, if we look at BSE Sensex, you can look at the graph that the maximum return has been generated around 10,577%. And you can look in the graph as well that there are two instances where the market crashed more than 50%. The one is 2008, and the second is the recent 2 year back Corona crash, which we all witnessed live. So what I'm trying to imply by showing you the graph is that the tremendous growth in Indian capital markets over the last 20 years. And this is just the beginning. We are in a phase of the Indian economic growth story that is going to last for probably a century. So this is the right opportunity. This is the right time to start in the Indian capital markets. So folks, we are not going to focus on the negative aspects of the Indian economy, as there will always be something to be worrying about. Rather than looking at the news, we are going to look at the positive facts about the Indian economy. So Indian markets have grown at a CAGR of 14 to 15% over the last 18 to 20 years. So what I'm trying to imply here is that even though there are some negative aspects about the Indian economy, the growth rate of the Indian capital markets is somewhere around 14 to 15%, including dividends. That's the tremendous growth, provided that India is still an emerging economy. And the real economic growth of India is somewhere around 3 to 4%. And we can add 3 to 4% of inflation as well. So the nominal growth is around 6 to 7% from last 10 to 20 years. And trust me when I say this, even though the Indian economy is not doing really, really well from past 2 to 3 years, but if we look at the big picture, this economy is about to explode in a big superpower in the next 10 to 20 years. Now let's look at the real GDP growth rate of the last year. The India in first quarter of 2022 and 23 was around 4% higher than 2019 and 20. So we can say that India is coming back to the track. Slowly, but surely, we are getting to that growth rate. With more than 100 unicorns valued at $332 billion, India has the third largest unicorn base in the world. So as you all are MBA students, you all know what a unicorn is. A unicorn is a startup which is valued at $1 billion or more. So currently we have around more than 100 unicorns, which are valued at more than $300 billion. That's a phenomenal achievement for a country which has a per capita income of only $2,000 or so. So India has the third largest base. So if we look at the large big economies in the world, including UK, Japan, China, and all the United States of America and Canada, India is the third largest unicorn base in the world, which is a phenomenal record. As of September 2022, India's forex reserves stood at $524 billion, which is a great number once again. India will keep on improving on these things. And the nominal GDP at current prices is estimated at US $3 trillion. Like, as I always say, there will be something negative about the Indian economy, but these are the positive facts about the Indian economy. We are not going to look at just the positive data, but we are going to look at the actual data which is available. And these are the actual data. Now, if you go into the business news, in the financial press, in the mainstream news, you will find every single thing negative. But these data facts are actually telling that India is set to grow at a rapid rate. And even the GST revenue collection stood at 1,40,000 crores. Over the last few quarters, the GST collection is over and above 1,40,000 crores, which is somewhere around $17.92 billion. And India's GDP production let's look at we are living in the greatest time for India, as the Indian economy is set to become one of the largest economies of the world over the next 50 to 20 years. Now, one more thing that is going to really impact Indian economy is that the median age, the middle age in India is around 28 years old. Most of the youngster in India is somewhere around 28 or 27 years old, which makes India the youngest nation in the world, which is once again the great sign. As more and more people get the inspiration to start their own startup, we will get more opportunity in the jobs as well as in Indian capital markets. And one more thing that about the Indian economy that most people ignore is that India is an asset light economy, focused mainly on service sector like IT and SaaS, software as a service. Now, software as a service as an industry is going to explode in our country. So why are we talking so much about the economy? As Indian economy grows and matures, as more and more enterprises get established, normal people like you and I will face double benefits. Now, what are those benefits? The number one is improved quality of jobs. The more employment opportunity we will get, the more economy is going to grow. More startup culture, more job opportunities, and the result will be expansion in Indian capital markets. As more and more people will have more money to spend and more money to invest, the Indian capital markets will definitely grow. Expansion in capital markets is really crucial for the growth of any economy. For any economy, capital markets play a crucial role. As you all know, that capital markets are just the intermediary between the capital providers and capital users. They provide a channel for the capital to flow from savers to efficient capital creators. So this whole phenomena, this whole flow chart from growing economy to better job opportunities to better capital markets, all these three are interlinked. The more and more people earn, the more they will have investment to discretionary income for investments to make, and the more the capital will flow to the Indian capital markets. Now, we will look at the importance of capital markets for an economy. Now, for an economy to grow, it needs capital, right? And banks can only provide so much of that to their shareholders and debt users. So there comes a need for capital markets, where enterprises can look for the capital they want. And capital markets are the market where businesses can tap into the power of public markets to raise capital for their ventures. Now, as more and more startups, more and more companies get established in India, they will need the capital. They will need the capital to run their show. And corporation and governments can also raise funds from public at large by issuing them securities. So the capital market is really crucial at this point in India. Now, some people will say, "Yeah, capital markets are overvalued at current PE valuation." Folks, we are looking at PE valuation relative to the last year's valuation. If we look at the broader picture, if we look at over the next 10 to 20 years, the growth in Indian capital markets is so high, is so high that no PE valuation can justify it. So looking at the thing from narrower perspective will never give you the result you are seeking. So you need to think for the next 10 years, for the next 20 years. As you all are MBA students, you all are young, you all are looking for more opportunity. So the one thing I will advise you is look at the broader picture. Now, some CNBC guy will come here and say, markets are overvalued, sell everything and sit at cash. We say, boss, we are looking for the next 10 years, next 20 years, next 30 years, because we are still young. We are still in our early 20s. We are looking to start our own ventures. We are looking to save more money. So you need to focus on the broader picture. Now, expansion in capital markets is a channel for the capital to flow from savers to efficient capital allocators. Let's say you have a lot of income in your hand and you are looking to invest. Now, you are not going to go out there and invest in some bank FD or some corporate bonds or government bonds, because you need to beat inflation. And now to beat inflation, you need somewhere around more than 10% of return at least, because the inflation somewhere in India is currently around 6.9 or 7%. I don't know the exact numbers, but the inflation hovers around these numbers. So what you need to do to get from point A to point B is to look for smart capital allocators. And smart capital allocators will not come to your home. You will go to them via capital markets. So all in all, point is you need to have a broader perspective and you need to invest in some businesses that are efficient capital allocators, those that can use your capital at best. And capital markets provide a wonderful opportunity for it. Don't look at the PE valuation of current markets. Look for the 10 years expansion in Indian economy. Indian economy is set to grow. India corporate earnings are set to grow. So we need to use capital markets as much as we can. Now we are talking, as we are talking so much about capital markets. Now we are going to talk about how they can make us wealthy. At the end of the day, you and I both want to make money. We both want to improve our living lifestyle, our family's lifestyle, and we want to have abundance in our life. So the first point in the capital market importance is, as the Indian economy grows at a rapid rate and GDP per capita grows from $2,000 to higher levels, the increase in discretionary income will be manifold. Now, what do I mean by that? When the GDP per capita grows from $2,000 a year to, let's say, in the next 10 years it goes to $3,000. Now the discretionary income, the extra income that you can spend on anything you want from the basic necessities of life, that extra income you are left with will be manifold. Let's say $2,000 you have today, and you spend more than 50% of your income on your basic needs. You will have only $1,000 to spend on the stuff you want. Now, let's say the GDP per capita grows from 2,000 to $3,000. You will still spend only $1,000 or $1,200 on basic needs now, but you will have extra income to spend on the stuff you want to improve the basic necessities of your life and to demand abundance. And with this increase will come a need to invest more and more in the markets. Like as I said before, people have more money to save, people have more money to invest, especially capital markets way investment. The more you invest, the more you are going to grow. Now you have more income as the discretionary income has gone up. Now people are becoming more and more aware about the importance of capital markets as the only reasonable avenue for them. Now, a typical boy or a girl in his early 20s is not going to go and invest in bank FD. They are going to spend that discretionary income in stock market, in the capital market of our country. The awareness campaigns that we have seen from companies like Grow, Zerodha, Upstocks, all these, they have played a huge role in this paradigm shift of Indians. Now, Indians are slowly realizing that the extra surplus money that we have is not going to go into some FD, some insurance policy, or some LIC. They are going to go into the Indian capital market. It can be via mutual funds or direct stocks or PMS or maybe some alternate funds that people look for. But at the end of the day, everyone in India who is in his early 20s, late 30s, or whatever age they are going to come to Indian capital markets as this awareness is becoming more and more commonplace for them. Another factor that will play a crucial role in Indian household wealth increase is the financialization of savings. Like, sir, I still remember I was reading a report from RBI that a typical Indian has a lot of his or her wealth in gold and real estate. Like we Indians think, boss, let me just buy some jewelry and I'm going to become financially independent, or I'm going to invest in some flat out there and I'm going to eat the rent for the rest of my life. But this paradigm is absolutely wrong. And the fact is that 90% of our wealth for a typical Indian middle class household is stuck in these two assets, gold and real estate. So when the financialization of these savings will move from gold to stock market, the growth in stock market is going to be manifold. Like people are slowly realizing that gold can't beat inflation. Real estate, residential real estate cannot beat the inflation. As rental yields, I'm talking about Delhi market, sir. The residential rental yield on real estate is somewhere around 2 to 3%. You are hardly beating inflation with that, and the capital appreciation is not so good over here. So the transfer from hard assets like gold, real estate, and so-called jewelry. Some Indians invest in jewelry as well, thinking that jewelry is an investment, but that's not the truth. To stock market will create some sensational amount of wealth for us. So all in all, growth in Indian economy, growth in corporate earnings, and the financialization of our savings is going to create immense growth in Indian capital markets. Folks, if you take nothing from my session, but take these three things, Indian economy is set to grow at a rapid rate. Don't think about the next 5 years or next 1 month or next 3 quarters. Think about the next 10 years, how India is rapidly changing in technological front point and how corporate earnings will grow and how your savings will be financialized in the stock market. And when this happens, our standard of living and both Nifty and Sensex will go upward and onwards. So these three factors, economy, corporate earnings, and our savings will boost the Indian stock markets. So how to benefit from these changes? Like I told you a lot of things that are changing in our country. Paradigm shift is changing, and financialization of savings will occur. So how do we benefit from this? Like Mr. Piyush, tell us how we can make money from it. The only way to benefit from these formalizations is to participate in the Indian capital markets as soon as possible. Like a lot of people say, boss, let me get to that job, then I'll start. Let me get that promotion, I'll start. I'll start investing once I reach 25 years of age. But this paradigm is absolutely wrong. Whatever savings you have, let's say you have only 1,000 rupees today. Let's say you are a student and you have only 1,000 rupees. What I will suggest you is invest 500 of that in the capital markets. And you ask me, boss, 500 is such a small money. 500 will not make me a millionaire. No, the goal with 500 is not to make you a millionaire, but to let you have that real work experience. To sitting in a class and reading about stock market, reading about investment, analyzing stuff on Excel spreadsheet is totally different from actually investing in the market. Like I still remember, I was 15 years old. I used to read a lot of balance sheets, a lot of financial stuff, and I used to watch a lot of YouTube videos, thinking that, boss, I'm going to destroy the stock market. I'm going to become the next millionaire in a few years. But when I actually started, I incurred a few losses. So the reality is totally different from what you study in academics. Academics will teach you how to apply a formula and get the desired answer. But the markets are totally different. So to get over that paradigm is to start investing as soon as possible. Indian markets pose a great opportunity to make a lots of money over the next 5 to 10 years. There's a typo over there, kindly ignore it. So over the next 5 to 10 years, Nifty and Sensex are currently around at 59,000 and 17,000, if I'm not wrong. So over the next 5 to 10 years, I won't be surprised if the index doubles in value. So you need to act fast and you need to act with small sums of money. Don't wait to get the big money. Start with small sums so that you are comfortable with the volatility of the market, as markets are volatile. Yeah. So, and the third point that I'm going to focus on is to buy quality stocks. Don't buy some low quality PE stuff stocks and sit patiently as they grow. And now I'm going to take you through our process, how we pick quality stocks at Shark Square Capital. Now, picking quality stocks is not a Albert Einstein wali IQ thing. Anybody of you can pick great stocks easily. You just need to have the right framework, and the right framework is the that we follow at Shark Square Capital. So, our framework to pick quality stocks is inspired from Mr. Warren Buffett's philosophy. Our philosophy rests on his principle of value investing. Now, when I was 15, I was reading about Mr. Warren Buffett in the library, and I read a lot of books, watched a lot of videos. So, this philosophy is actually very simple. You don't need to have some MBA finance CFA charter to follow his philosophy. But the thing is, it's not, it's actually simple, but not easy to follow. Now, I will tell you why it's not easy to follow. The thing is, you are your own biggest enemy in the stock market. You are going to do the stuff that doesn't make sense from an economic standpoint. Framework number one, look for high ROCE companies. Now, when we are managing our clients' wealth, our own money, so the first step to screen out the stocks is that we look for companies that have high ROCE. Now, what is ROCE? It's simply return on capital employed, as you can see in the slide over here. So now there are two questions here: why ROCE and why higher than 15%? Why this 15% number is there? The 15%, the reason behind 15 is that the cost of capital, the price of money for a business in India is somewhere around 5-15%. Now I am going to take you behind the math of the calculation of this 15%. This cost of capital is the price of money that a company raises from the market. It includes weighted average cost of both the sources of funding, that is debt and equity. Like folks, as you all know, you all are MBA students, you all know that there are only two sources through which a business can be funded. The one is debt and the second is equity. For a typical business, the capital structure of that business will be funded by both of the sources of financing. Now, weights might be different. You can have, let's say, 50% debt, 50% equity, 60% debt, and 40% equity. Now, weighted average cost of both of this funding is called weighted average cost of capital. As you all are financially literate, so I won't be explaining much about it. And the ROCE, the return on capital employed, it shows the return generated on the invested capital, which includes both debt and equity. The return generated on that money is called return on capital employed. Now let's look at the math. The math behind cost of capital is simply this: the cost of equity multiplied by the weight of equity plus cost of debt multiplied by weight of debt gives you the weighted average cost of capital. For a typical business in India, looking at the risk-free rate, the cost of capital is somewhere around 15 or 16%. The number typically hovers around these two numbers, as I have seen in my practical experiences. The cost of equity, according to CAPM, CAPM is capital asset pricing model. It's a risk return model that you all know, is risk-free rate plus beta multiplied by market premium. Market premium is simply market return minus risk-free rate. So as of today, you can go on Bloomberg, you can check the risk-free rate. Risk-free rate is currently 7.373%. This is a 10-year government bond yield. So when we look at stocks, when we are analyzing a company, the first thing we do when analyzing a company financially is to calculate its WACC, weighted average cost of capital. And to calculate WACC, you need risk-free rate. And the risk-free rate currently is 7.37%. Plus beta. Beta of stock simply tells you the systematic risk that is included in the market. It tells you how your stocks moves with the market. The market has a beta of 1. Now, for the example, let's take the beta of 1 multiplied by market return. 12.1% is somewhere around is the average return that Sensex has given over the years, including dividends, minus risk-free rate. You put in this equation, the answer you will get is 12.15%, is somewhere around 12.1% only. Now, cost of debt for a company that we follow is quite simple. It's risk-free rate plus yield spread of the company. When you calculate cost of debt, there are several factors that you need to look at. The number one factor I will suggest you to look at is the credit rating of the company. That there are around 2 or 3 credit ratings in our credit rating agencies in our country. The number one is CARE and ICRA. We look at the credit rating report of this company and we estimate a synthetic yield spread of that company. Now, the risk-free rate plus yield spread of the company multiplied by 1 minus tax rate. Now, when we are valuing stuff, we always look at the after-tax cost of debt. So you need to make sure that you deduct the tax aspect of the cost of debt. Risk-free rate plus yield spread multiplied by 1 minus tax rate will give you the cost of debt for a company. Now, multiplying both by their respective weight in the capital structure and summing them up will give you the cost of debt. Now, this is the first step that we follow to calculate the real intrinsic value of a company. Now, WACC is really important. Now, we will compare WACC with the ROCE. Sir, is there any question with any students? Any questions, sir, till now? All right, I'll take it as a no. The math behind ROCE. Let's look at the math behind ROCE. Now, to fund a business, you need to have both debt and shareholders' equity. Now, return measure is earnings before interest and tax multiplied by 1 minus tax rate. Now, EBIT is operating income for a business. Earnings before interest and taxes multiplied by 1 minus tax rate. Now, what I am assuming is that we have already deducted taxes from EBIT, is that the company is already funded with entire equity. We are not going to deduct the interest component on it. We are just going to deduct the tax and we are left with profit before interest. Now, this profit before interest will be divided by total capital employed. And the answer will give us around the 15% ROCE number if a company is great. Now, the ROCE must be above weighted average cost of capital. Folks, like this is the golden rule of investing in any company. The ROCE must always be higher than the weighted average cost of capital. Otherwise, there will be no value creation in the company you are investing in. So because the reason behind is that I focus too much on these two numbers is that a lot of people think that profit after tax is the real measure of a company. Now, folks, a company can be profitable. A company can make a lot of profits, but if the ROCE is not higher than the weighted average cost of capital, the actual value creation is nothing in that company. Now, the share price will fall down, even though the company is profitable. So you can take it note as well when you invest in the market. Focus on these two numbers, ROCE and weighted average cost of capital. You need to have the sense, a typical idea behind the value of these two numbers, when why ROCE is higher and why WACC is lower. So compare these. This is the first step in picking quality stocks. Framework number 2, look for high free cash flow to firm generating businesses. Now, folks, we come to the second point that we follow as Shark's Swallow. The second point that we look for is high free cash flow generation. Now, what is free cash flow? Folks, free cash flow is that number which is left with a business after paying all its claim holders, after paying every single thing, paying to equity holders, paying to debt holders, the amount you left is called free cash flow. Now, to calculate free cash flow to firm, take the formula EBIT 1 minus tax rate, the previous formula we used in ROCE, plus non-cash expenses. Non-cash expenses are those like depreciation and amortization, minus changes in working capital. A company needs working capital to fund itself through day-to-day activities. Now, deduct that also, and minus capex, capital expenditure. A company needs to reinvest for future growth. Without reinvestment, there is no future growth. So the number you get after deducting all this and adding all this number, you will get free cash flow to firm. A firm should have the high free cash flow year after year, ignoring net earnings and look out for high FCFF. So, folks, once again, the point is that you should be focusing on the free cash flow aspect of the business and not the net earnings. A lot of people lose money in the market because they ignore the cash flow statement of the business and only look at the net profit and the balance sheet of the company. So, folks, focus on the high free cash flow generating businesses. That the more you generating free cash flow, the more you will create value for your shareholders. So that's the second thing we look for in a company, that the free cash flow should be higher. Framework number three, look for an economic moat in the business. Like, folks, there is a mobile phone in the phone segment. It's called iPhone. Apple makes it. Apple manufactures it. iPhone. Now, a lot of people pay a hefty amount of premium to Apple for an Apple iPhone. Apple iPhone is somewhere around 80,000 or 1 lakh, or maybe even above that. So you need to find a particular business that has a moat around it. Now, what is a moat? To understand a moat, we need to understand the economic theory. The economic theory tells us that if any firm is earning high ROCEs, that and then it will attract competition, and the ROCE will revert back to cost of capital. Now, we all have studied economics in our economic classes and MBAs and CFAs, that if any firm is earning high return on capital, it will attract more and more competition to it. Now, when more and more competition comes, then supply goes up and the demand remains the same. Then the prices will fall down. Now, when the prices fall down, the profit margins shrink of the company, and companies will start earning less and less money, and that less money will result in lower ROCE, and that ROCE will revert back to the cost of capital, which means ROCE is equal to WACC. So you need to find a company that can fight the competition. And to fight the competition, a company must have a great barriers around the business to protect that high ROCE. Look for companies that can protect its profit. Now, when I gave you the example of Apple, Apple has a huge brand name and a huge R&D behind the Apple iPhone. When you buy an Apple iPhone, basically you are not buying just a phone. You are buying a status symbol. You are buying that brand. So look for great franchises that has economic moat around its business. Now, Mr. Warren Buffett coined the term economic moat. Economic moat is simply something that protects the business from competition. Some examples of an economic moat are high barriers to entry. Let me give you a simple example for it. So one of the companies that we hold is CDSL, Central Depositories. We have been holding it from last 1.5 years, and the returns are really phenomenal. So the moat behind CDSL is that it has high barriers to entry. To set up a depository, you require somewhere around 200 to 250 crores of starting capital. So basically, if you want to go out there and say, boss, I am going to challenge CDSL in their own field, then you need 200 crores. And there is one more economic moat behind CDSL is that customer retention. More and more customers want to stick with them because the changing of customers is really expensive and truly cumbersome. So you need to find such businesses that has high barriers to entry. And the second economic mode can be monopoly because of regulation. CDSL has one other monopoly because of regulation. It has 75% market share. It is in our portfolio, so it's not a recommendation because of regulation. Now, SEBI regulates these depositories and the entire capital market. So, because of regulation, our businesses has a monopoly and high barriers to entry. Customer stickiness due to friction in changing. Now, these are the few examples that you need to look in your business. Now, let's say you are analyzing a company, ABC Limited company. Now, you need to think that, boss, what is something in this business that will protect protect the business from competition, outside competition, and that will in turn will protect the ROCE. So a firm should have high bargaining power as well, so it can fight the competition. You need to fight the competition. Five forces framework. I hope you all have studied the five forces framework given by the Michael Porter of Harvard. Folks, we always use this framework to analyze a particular business or a particular industry. Five forces framework to analyze the prospects of the industry and how a firm scores on each factors is also used to determine the economic moat of the company. Folks, I once again said the more successful you are, the more competition you will attract. Like success always attract haters. Then the more haters you are, the more life will be tough for you. So you need to have that idea how to analyze a typical industry or a typical business. Now, five forces of framework is more than just a typical MBA class session. Now, I am going to take you through how we do the five forces framework analysis. The number one is threat of new entry. Now, just give me a second. Yeah. The threat of new entry is that new competition will enter in the business. I gave you the example of CDSL. That CDSL has zero threat of new entry. No, none of us, like you and I, cannot go out there and challenge CDSL saying, boss, we are going to set up a new subsidiary. So the threat of entry is almost zero in the case of CDSL. Supplier power. Supplier power, in the case of supplier power, I would say CDSL does not have that much power in it. No, because the number of suppliers in the depository industry is only two, NSDL and CDSL. So I would say it does have some supplier power, but not that much. Threat of substitution. Threat of substitution has an effect on CDSL because people can always use NSDL instead of CDSL. Now, buyer power. Buyer power has zero, nothing to do with CDSL because CDSL will charge a price that they want. Now, NSDL can reduce its prices, but the friction in changing from CDSL to NSDL is way too high. So we can say that CDSL has a bargaining power as well. Now, the fifth point is competitive rivalry. You need to look at a particular industry from the outside in. You need to say, boss, how many competitors are there and how the competition is among them. Now, in the case of depositories, we are looking at only two main players. The first is NSDL and the second is CDSL. Now, these two firms are fighting with each other, but the CDSL is the dominating one. It has around 76% of market share, according to the annual report and according to the data filed with SEBI. So, all in all, these two businesses are really great to own. And once again, folks, these are not the recommendation that I'm giving to you. I'm just giving you an example that how we apply this framework to our investing. Now, let me give you one more example before we move on to the next slide. Like a lot of you might be using the Vodafone SIM, some of you are using the Geo SIM, and some of you are using Airtel SIM. Now, these three players in the telecom sector, they have a huge competition rivalry. They are literally fighting on price. And when someone fights on price, shareholders are not going to make a lot of money because when they are fighting for price, they are selling their services for lower and lower cost every single day. You need to find someone who has that pricing power in them. So for us, for our clients at Shark Square Capital, Vodafone, Airtel, these companies are not so good because they are fighting on war. Threat of new entry is always there. Buyer power, the buyer power is still there. I would say that friction of changing is really high, but the threat of substitution is really high. If Airtel raises its price way too much, people will switch from Airtel to Jio. So that's not an industry you want to be in. You want someone who can charge a higher prices year after year and without the fear of loss of customer. So these were the five forces of framework that we used in our Sharks for Capital's portfolio. Framework number four, look for a reasonable price tag. Folks, when you have analyzed a business, you need to look at the valuation. Valuation is probably the single most important metric that will make you either lose money in the market or will make you to beat the market. So a business can be good in all three aspects: high ROCE, high free cash flow, and even high bargaining power with economic moat. But if the valuation is too high for a particular business, it's a bad investment. Folks, at the end of the day, you need to buy something which is worth around rupees 10 for rupees 5. You need to have that margin of safety with you so that you can say, boss, if things go wrong, if I am wrong about the prediction of the business, about the forecasting of that business, then I can save myself from losses. So you need to look at a reasonable price tag. When I say reasonable, you need to know that what reasonable actually is. For as a goal, so our goal is to buy these businesses at reasonable valuation and not way too high prices. So you need to buy stuff at reasonable price. Now let me give you an example of what reasonable can. A business can be outstanding and there will be some premium attached to it. So in that case, we are ready to pay that premium. Folks, by saying this, I simply mean that if a particular business is trading at 20 times PE, 25 times PE, we need to be ready to pay that premium. Sometimes you things are too good to be missed. Like you cannot miss the opportunity sometimes, because if there is a great business, the market will definitely pay will attach a premium to it. So you need to understand this is all subjective. For 2%, the valuation will never be the same. So you need to understand that when it is the right time to pay a particular price. Our goal is to get the most out of our skill. We can't make the market, so we need to adjust and adapt. It pays to pay a premium. So, folks, if you are buying a phenomenal business, a powerful business, then you can pay a premium. But always remember, you need to pay a reasonable price for your investments. You cannot buy something overvalued so that you can make money. Now, when I say overvalued, a typical company comes in my mind, which is Adani Group. Now, folks, I'm not recommending any buy or sell decisions over here, but the Adani Group stocks are truly overvalued in my opinion. So we need to stay away from such stocks. We need to look for stuff which is high free cash flow generative, high profitability, high ROCE, low debt. So then only you should consider paying a premium. Otherwise, stocks like Adani, with a lot of debt on their balance sheet, you need to avoid such stocks. So this was the valuation framework that we use. Now, how do we decide on valuation? There are two ways. There are only two ways that we can decide on a valuation, is that by using a traditional DCF model. DCF is simply discounted cash flow, where the present value of all the future cash flow is the intrinsic value. Now, folks, due to the lack of time, I won't be giving you a lecture on DCF as it might get a little bit boring. And the second method to look at valuation is that a company should be trading at below its 5-year median price to earnings ratio. Folks, when we invest in stuff, we need to look at what the market is paying, what the market is pricing at a particular point in time for a particular company. So the second way, which is quite easier to understand, is that the stock should be trading at below 5-year median price to earnings ratio. You need to look at the PE, and then you can say, boss, I am going to do a traditional DCF. So these two are the stuff that you can use to value a particular stock. So cash flows, growth, and risk determine the real valuation of a business. As I always said, boss, look for high free cash flow. If a firm is producing high free cash flow year after year, then obviously the market will attach a premium to it and be ready to pay that premium. So, folks, these are the four frameworks that we follow at Sharks for Capital. The number one was high ROCE. Let's just look at the first one. High ROCE, high free cash flow. Second point. Third, economic mode, where company has a bargaining power, purchasing power, and dominance in its industry, low competition, high barriers to entry. Fourth, reasonable price tag. You need to look at low valuation. You need to have that sense of intuitiveness in you so that you can say, boss, this particular company is quite cheap related to its fundamentals. And now we look at the portfolio management. As we all are managing funds for our clients, for our own families, my mom is invested, my co-founder's family is also invested in our fund. The portfolio management we follow at Sharks for Capital is quite boring. Yes, you heard that right. We are boring fundamental investors. As long-term investors, we don't churn our portfolio as frequently until and unless there is some adverse change in the fundamentals of the business. Folks, as I have taken you from the economy of India to the most bottom aspect of our economy, that is business. When you buy a stock, don't sell it until and unless there is some adverse changes in fundamentals of the business. Now you might say, boss, I don't want to hold a stock for next 10 years. In that case, you should probably book profits. But as we are managing someone else's money, we can't do it. As we are budding institutions, we need to follow a typical framework and a typical process to manage our portfolio. For you, I would suggest, boss, you are in your early 20s, you should probably book some profits when you gain, let's say, 50% or 60% on your investments. So Our goal and fees is based on our performance related to Nifty 50. Folks, we don't charge a management fee at Sharks for Capital when we're managing our money. We charge fees only based on our performance related to Nifty 50. If we beat the index, we are going to charge a fee which is around 5%. And the process is the most boring of all, as it requires doing nothing and riding the fluctuations of the market. Now, earlier in the meeting, I said, well, the biggest enemy for an investor is you yourself. Now, let me tell you why. You are going to do stupid stuff in the market. You all are MBA students. You might feel, yes, boss, I have an MBA from a reputed college. I am going to go in the market. I'm going to make a lot of money. But the reality is, it is not so easy. And reality is quite different from academic books. Because you, once you experience that fluctuation in the market, that market is swinging widely, you are going to sell the stuff for no reason whatsoever. I still remember selling ITC last year, not last year, but back in 2021 at 225 rupees. I still don't know why I sold ITC stock. I bought the ITC back in March 2020, somewhere around 170 rupees when the market was crashing. And trust me, ITC was one of my best investments of all time. I made a handsome 75% return on it back in 2021 when I sold, and I sold it somewhere around 230 or 225. But that was a big mistake. ITC is currently trading at 335 rupees, if I'm not wrong. So, folks, you are your biggest enemy in the stock market. None of the guys out there, some big guy out there is your enemy. Your own stupidity, your own lack of patience will cost you money in the market. Remember this when I say it. Portfolio management should be boring. It should not be fireworks. This is not Diwali that we are celebrating. This is portfolio management. This is stuff. This is the stuff that you requires the most patience. Because we are Shark Shore Capital, we are a company, we are a budding startup. We need to be boring. So to let the compounding do its job, you need to sit quietly in your room without churning your portfolio. The only way to make sure we don't do something is not to look at daily prices. Folks, one more advice I have for you is to stop looking at stock prices every single day, every single hour. Once you buy a stock, once you have done your due diligence, sit quietly and let the compounding do its work. Don't look at the stock prices. Don't look at it in the financial newspapers, in the financial news, in your mobile phones. The best stuff you can do is to ignore your investments on a day-to-day basis, but always keep an eye in every quarter. As we are managing something in the tune of seven figures, our mistakes will highly affect us. As I already told you that we are still a startup, we are still a young budding startup, we are bootstrapped. हमारी गलतियां will cost us a lot of money. Our reputation is at stake. Our skill set is at stake. So we need to make sure we don't do something stupid. And as this goes for retail investors too, they should not churn their portfolio as such. Folks, ज़्यादा trade मत करना. Don't trade too much. Trade in the market. I'm not saying that you should not be trading in the market. Trade, but make sure you protect your capital. Protection of capital is the utmost priority for a retail guy, because you have only so much of capital with you. You are dealing with small sums of money. You are not going to become some billionaire hedge fund manager. So you need to understand that doing something stupid will cost you a lot of money. We follow a simple mantra to make sure we don't do something stupid with our clients' money, and to make sure that our clients earn a superior return, which is to sit boringly. Even if the market is doing something stupid, we do not need to participate in. So this was a framework of our investment strategies at Shark Square Capital. So let's quickly review it, folks. The number one thing we look for is the high ROCE. Second is the free cash flow. Third is economic moat, and you need to do a 5 forces framework analysis. Reasonable price tag, and portfolio management should be boring. So I would like to recommend some books as well before we conclude the meeting, and then we will go for some question and answer if sir wants. The first book I would recommend is Diamonds in the Dust by Saurabh Mukherjee of Marcellus. Diamonds in the Dust will definitely teach you about how to look for diamonds in the Indian market. The second book, 100 Baggers, like everybody wants to make 100 times their money. This book will give you a framework on how to go about finding those gems that will make 100 times your money. Now, the financial shenanigans. Folks, one thing that I did not tell you is that we follow a quantitative framework to analyze companies so that we can catch a fraud. How to catch financial fraud is really, really important in the stock market. Now, financial shenanigans will tell you Now, the next three books is The Most Important Thing by Howard Marks, Coffee Can Investing, and Principles by Ray Dalio. These three books have really helped us in analyzing stock market investments, in analyzing the market, and Principles will teach you how to go about setting up a business that you always dreamt of. So, folks, this was my presentation. I hope you all loved us. You love the framework that we follow, and we are ready to further question and answer if you have any.
Thank you very much, sir. Thank you very much. Wonderful presentation.
Thank you, sir. I hope you liked it.
It's a loud applause. Yeah, I actually covered most. I very much liked your 5 forces framework.
Yes, sir. Thank you, sir.
No, beautiful slides you had. Now I request some of our students to ask some questions so that it will be more interactive.
Sure, sir. I'm looking forward to it, sir. I would love to answer the questions, sir.
First,
yeah.
Yes, Radhesham will come and ask question. Parle. Space event. Please give some space so that.
Yeah.
We have wonderful students, sir. They are very much interested in this financial markets and stock picking, valuation, and how the markets work. You have
That's
covered
truly great, sir.
You have covered everything in a nutshell, sir.
Glad you liked it, sir.
Yeah, you just introduce yourself.
Good morning, sir.
Morning.
Sir, actually, you explained about how we should be avoiding like overvalued stocks, and you gave the example of Adani stock and how you think that because of their, untrustable debt equity ratio, it is not a stock to be preferred. So, could you explain more about the controversy on Mamaearth recently? There's the stock was said to be overvalued. Can you please elaborate on that?
So, folks, at Shark Square Capital, we do analyze IPOs. And one of the IPOs that we analyzed last year as well as this year. Last year, we analyzed Zomato. The thing with Zomato was we were truly shocked that company can be traded at such high multiples. And the same goes for Mamaearth. Like, if I'm not wrong, I remember it correctly that the net profit for recent year is somewhere around 14 crores, or end of recent quarter is around 3.56 crores. I don't remember the exact numbers, but the stock is trading at 1,000 times multiple to its price to earnings ratio. Folks, this is a clear example that a particular IPO in India for a new age company is a pump and dump scheme. Like, we truly do not know how these founders come to such valuation. I do believe that it's a pump and dump scheme, not a recommendation, but you can look at the previous IPOs. You can look at the Paytm IPO. It crashed around 80%. Look at the Zomato. It was trading at 130 plus and now it's trading at 2-digit multiple maybe. Now, folks, to avoid such blunders in the market, look at free cash flow. Not even free cash flow, look at operating cash flow. You all know how to calculate operating cash flow. The net profit is based on accrual accounting, but operating cash flow tells the real truth about the company. Before you invest in any IPO, ask yourself, what's the operating cash flow of a company? For Mamaearth, the number is not so good. I would say avoid this stock because, folks, you have limited amount of capital. You cannot do such mistakes. Aane do market mein, let it come to the market. We will see what happens, how the company grows, how the product features grows, and then we can decide whether to buy or not. Folks, always be patient in the market. A particular IPO comes, people buy it, pump and dump, it goes down, people lose their money. This is the typical bonanza of stock market that we are seeing from last 1 year. So I would say wait for a few while. Look at OCF, operating cash flow, and look at how the market reacts to the Mamaearth. So that's the least I can say. But don't do such mistakes without looking at operating cash flow. I hope I answered your question.
Yeah, you did.
Yeah.
Please introduce yourself.
Sir, good afternoon, sir. This is Venkata Krishna. Sir, you said there is a many ways. There is a even though layman also can understand the market and pick the stocks. You said, sir.
Yes, sir. Yes. Yeah.
Can you say that there is a simplest form to pick the stocks and invest in the capital markets, sir.
All right. So let me give you a simple strategy to pick great stocks. Folks, look at your house. Look at the stuff that comes in your home. Many of you use Ashirwad Atta. Many of you use Dove shampoo. A lot of FMCG stuff comes in your home. A lot of electrical wires, Havells wires come in your home. So the best advice I can give a layman investor is to be aware what is happening around your house, about what is happening around your economy. Folks, whenever you go for shopping, whenever you go to a retail store, always look at the backside of a particular product. It might be of Nestle, it might be of HUL, it might be of ITC. For these companies are multi-baggers over the years. ITC has written somewhere around 10,000 crores of cash in dividends alone. In dividends alone, in 10,000 crore of cash. So the best advice I can give you is to be aware what is happening in the economy. A lot of people, they read newspaper, they watch news, become negative and say, boss, stock market is a gamble. Everybody loses money here. But I would suggest you is to look at the product and services that you use on a daily basis so that you can pick some quality company. Folks, if you look at the returns of Nestle, HUL, ITC, Havells, these companies are great companies. They are making a lot of money. Now, let me give you another example of ceramic tiles. There might be tiles in your washroom. Now, ceramic tiles, a company makes Kajaria. You might be knowing this, the company. The Kajaria is also a great stock. Now, I'm not recommending you any stock, but the best strategy is to be aware and look what's happening around you. Now, Apple, let me give you an example for the Western markets. Everybody owns an iPhone in America. Like it's a luxury in India, but only a few people actually hold Apple stock. Now, if you look at the Apple's balance sheet, they have around $100 billion of cash. A typical company cannot be making such amount of cash, but the Apple makes it and it flows back into the business. So you need to be aware, boss, what's happening around you and what are the products and services that you are using on a daily basis that are great companies. So that's the best strategy you can use.
Thank you, sir. Sir, sir, yesterday I view your profile, sir. You are the NISM and NCFM certified. Can you suggest the what are the courses and what are the certifications we can select and growth in capital markets, sir?
Sure. So the best certificate that you should pursue is NISM Research Analyst. One of the finest certificates out there. A lot of people do not know that they can upskill themselves using these certificates. These certificates are really useful. I would say it is way more important and way more practical than most of the academic books that you read in MBA. Like I have read all the academics books, CFA books, and every single thing. Boss, but the most practical ones are NISM. I would suggest all to take the research analyst exam and excel in it. It is both useful for your job purposes and it will give you a more realistic and practical approach to stock market. So NISM's research analyst certification. It will cost you around 1,500 rupees, not much. 1,500 रुपए लगेंगे आपके. You will get real understanding of stock market.
So sir also preferred the same certifications.
Yeah.
Our deans are also preferred the same certifications.
Yes, actually, most students do not know that NISM provides certification as well. So it's always great to understand about them. And your sir, he's a really great human being. I connected him on LinkedIn. So that's great that he's suggesting you. You should definitely go with it.
Thank you, sir.
Yeah, thank you so much.
Any other voice from voice side again?
Sir, good afternoon, sir.
Afternoon.
My name is Akash, sir. Sir, once upon a time, the S Bank has accepted a fraud called 5,000 crores. How they predict as a fraud, sir?
Yes,
When
bank. Yes, bank.
stocks are going up and sometime sometime the stocks are going up and are going when sometime the stocks are going down, but now it is improving as the stocks are up. What is the fraud between any explanation, sir?
So you are asking about Yes Bank scam, right?
Yeah.
So, folks, the best thing I can tell you about finding a fraud in the market, finding the fraud in a typical company, is to read the book Financial Shenanigans. Financial Shenanigans by Howard Schilling will give you a framework about how to finding the such fraud in a company. And the second book is Diamonds in the Dust. Diamonds in the Dust by Saurabh Mukherjee will also give you a framework and how to manage such companies and how to look for fraud in a company. Now, and the second thing, what I would say is keep your portfolio diversified. Like Akash, you never know what's happening inside of a company. Like you are a retail investor. We are also a small startup right now, but you can never know actually what's happening in the company. You never know. A typical CEO of a company will not come on a Zoom meeting and say, boss, we are committing a fraud. He will not come and say, boss, we are manipulating our stocks, we are manipulating our financial statements. So you need to be, say, boss, I have invested in this company, but I will not put my entire net worth on it. And if we talk about Yes Bank in the current scenario, I would say, boss, I would say literally there are 10 banks that are performing really, really well. Like recently, HDFC Bank's quarterly results came, they perform really well. And as a matter of fact, we are also holding HDFC Bank for our clients' portfolio. ICICI Bank, IDFC First Bank, these are the banks that you should be looking for. Like ignore a typical fraudster. Now, Yes Bank's brand has already tarnished. Trust me when I say this, I won't be surprised if Yes Bank changes its name in the upcoming years because the brand of Yes Bank has already been tarnished. So to spot the fraud, read these two books, Diamonds in the Dust and Financial Shenanigans. Second, keep your portfolio diversified. And third, after such thing has happened, never ever buy a particular stock which has committed a fraud. That's the best thing I can tell you. Avoid Yes Bank. There are literally tons of banks that you can buy. You can buy HDFC, you can buy ICICI. And once again, not a recommendation, just giving you an example.
Thank you,
Thank you, sir.
Pleasure.
Thank you, sir. It was a wonderful presentation. Actually, I have written down one board full of observations from your presentation.
Sure, sir.
Yeah, 1 minute.
All right, sir.
I have noted down one full board of board full of observations from your presentation, sir, for our students to note down. It is almost a full course on investments you have covered totally. Yeah.
We are in a tech startup too, so we do teach people how to invest in the markets. Currently, we have served almost 100 students, sir. So
Now I
yeah.
request Harika to give a vote of thanks. Please come.
Yes, sir. Please.
Good afternoon, sir. My name is Harika. So we are very thankful today to listen your class. So we have learned a lot of new things, mainly how to manage assets and to make money by using the stocks, sir. So I'm very thankful to listen your class, sir. Thank you.
Thank you so much that you liked it. I'm really grateful to give you the talk.
Thank you very much, sir. We'll follow your social media handles and keep interacting with you, sir.
Sure, sir. You can follow us on LinkedIn and Twitter as well, sir.
Yeah, thank you. Sir.
Thank you so much for inviting me. Thank you.
Sir.
So I'll stop sharing the screen, sir.
Thank you very much, sir.
Thank you, sir. Really, really enjoyed it, sir. Have a wonderful day, sir, and you have a wonderful class, sir.